The top business stories live from the Sky News City studio. Mortgage approvals down and a fall in house prices as buyers are squeezed by higher interest rates. Well, those higher rates help HSBC to more than double third quarter profits. And as the UK prepares to host an international summit on AI safety, we'll be discussing whether businesses are prepared for its impact. Good morning, this is Business Live with Ian King. Just a reminder that the COVID inquiry is hearing from Boris Johnson's former private secretary, Martin Reynolds. You can scan the QR code on your screen to follow live updates right now. Now, the number of mortgage approvals has fallen to the lowest level since January, signalling the effect of higher interest rates on the housing market. The Bank of England says lenders approved 43,328 mortgage applications last month, while the number of approvals for remortgaging fell to around 20,600, which is the lowest level since January 1999. Well, UK house prices are expected to fall both this year and next, according to Zoopla. The property portal says prices have already fallen in 4 out of 5 local housing markets this year, with prices overall down by 1.1% at present year on year. Well, Zoopla expects prices to fall by a further 2% next year. And that would make 2023 and 2024 the first years in which the UK housing market has recorded back-to-back price declines since the global financial crisis in 2008 and 2009. Well, the biggest falls were in prices were in commuter towns around London and the southeast of England, such as Colchester, Luton and Brighton, where prices fell by more than 3%. The highest growth rate was in Halifax in West Yorkshire, where prices rose by 3.6% on average. Zoopla also found a big rise in cash buyers, who accounted for 1 in 3 sales this year. Well, joining me now is Richard Donnell. He's Executive Director at Zoopla. Richard, good to see you this morning. So this is the fastest decline in house prices since 2009 that we're seeing right now.
Absolutely, and this is just all to do with the increase in mortgage rates, how much that's hit buying power. And as you've been alluding to with the data on mortgage approvals, it's really stopped people moving. We've got a quarter fewer people moving home this year than last year, as people who just don't need to move, they've already got a home, sort of sit on the sidelines and wait to see what the outlook is, particularly for mortgage rates.
That is very striking, Richard. I mean, which are the properties that are proving most difficult to shift in this market?
Well, I think it's really the 3 and 4 bed. It's the family home that was very, very strong market over the pandemic, is what everyone wanted. A lot of people have moved. I think, those family homes where you need a bigger mortgage, a bigger income, a bigger deposit, they're the ones that have really cooled off. Hence, we're seeing cash buyers who tend to buy cheaper properties. We've also got really strong demand from first-time buyers who like to buy cheaper properties. So the real sort of activity in the market is constrained to those lower price bands, as the sort of aspirational homes people are just waiting and seeing on rates.
I mean, it is noticeable. You do point out that there are some pockets of growth, for example, in places like Halifax. What are the characteristics of those markets that's helping them to hold up?
It's all about affordability, particularly in Scotland, parts of the north of England, where house prices just simply haven't seen the growth that we've seen in southern England over the last decade or so. And so even for a first-time buyer buying with a 5.5% mortgage rate, it's still cheaper to buy than it is to rent. So that's supporting the market. But I think whilst prices are still rising, they're rising far more slowly than they were rising a year or two ago.
Now, you mentioned a moment ago that the biggest driver of activity right now is first-time buyers. When did they last account for the biggest portion of the market?
Well, they've been strong for the last 2 or 3 years. Just before the pandemic in 2020, first-time buyer numbers were really strong, 2019 as well. And I think part of this at the moment is linked to the speed at which rents are increasing. Rents up 12% in the last 1 year, 40% in the last 3 years. So again, particularly for those who can access deposits from the bank of mum and dad or from savings, that's supporting first-time buyer demand, and that's also supporting the market.
Now, looking ahead, do you think that prices are going to need to come down further for affordability to improve, and that's the only thing that really is going to get activity going again, or one of them?
Absolutely. I think, we have to wait and see what happens to base rates, mortgage rates. But I mean, the outlook in money markets is that base rates, mortgage rates are going to stay higher for longer. So if we're not going to get the sort of affordability improvement from falling mortgage rates, and we're assuming mortgage rates ends next year at about 4.5% for a 5-year fixed rate, then we're just going to have to let incomes do the hard work. And that means it's going to take longer. So we're going to continue to see downward pressure on property prices, down 2% overall at a UK level next year. And look, prices might need to stay weak into 2025 to really reset house prices and earnings.
I think what will alarm some viewers is that your forecast of a 2% fall in prices next year, that's actually assuming that mortgage rates start to come down to around 4.5%.
That's right. I think, look, and there's room for prices to fall further. Even if we saw a 10% fall in house prices, levels of negative equity will be pretty low. So a lot of sellers have got capital equity to forego. But we've just got this inertia in the market. So again, we think next year is going to be another million sales year, 20% below average, as people who have moved over the pandemic. There's been a lot of movement. We're just seeing moves from people who really need to move. And a lot depends on that economic outlook.
I mean, we're obviously, we've got an autumn statement coming up fairly shortly, Richard. There's a lot of speculation about cuts to stamp duty. What sort of measures might the Chancellor introduce if he wanted to stimulate activity?
Well, stamp duty is an obvious one, although 60% of stamp duty tends to be paid in London, the South East. So there's already a lot of reliefs for first-time buyers, particularly in England, people in buying cheaper properties up to £250,000. So stamp duty just tends to hit those high-value markets. Again, I think from a Chancellor's perspective, we've got to get the nation building more homes. We need to increase supply, because if we don't increase supply, we're not going to ease the pressure on rent. So there are some short-term tactical things that can be done. But getting inflation down, getting mortgage rates down, I think would be the top ask for most homers at the moment. OK, Richard, got to leave it there. Good to see you as ever this morning. Thank you. Some other business news stories for you now. And the banking giant HSBC has reported a doubling of quarterly profits as it continued to benefit from the impact of higher interest rates around the world. The lender reported a pre-tax profit of $7.7 billion for the 3 months to the end of September. That was up from $3.2 billion in the same period a year ago, and it reflected a widening in the spread between what the bank charges borrowers and pays depositors. Well, the performance was also flattered by the fact that a year ago, HSBC took an impairment charge of $3.2 billion related to the planned sale of its retail banking operations in France. The bank said today that this and the sale of its Canadian retail banking businesses are expected to be completed during the first 3 months of next year. Well, HSBC also announced plans to buy back $3 billion worth of its shares. As you can see, the share price is currently off by just under 1/5%. The world's biggest educational publisher said today that its profits for the year would be better than expected. Pearson, which also owns the Edexcel Examining Board, cited stronger demands for its English language tests and its computer-based testing services. It also confirmed that its chief executive, Andy Bird, will step down on the 8th of January next year, when he will be replaced by Omar Abosh, who's currently head of Microsoft's Industry Solutions business. Well, Pearson shares are currently ahead by 1.25%. Mike Ashley's Frasers Group has sold the intellectual property of the online clothing business Missguided to the Chinese fast fashion retailer Shein. Under the deal, first reported by Sky's city editor Mark Kleiman, Shein will acquire the IP and trademarks of Missguided, while Frasers will retain Missguided's property, assets and employees, which have now been integrated into the company's fashion division. Well, Michael Murray, he's chief executive of Frasers, and he said today that rationalising the group's portfolio in the women's digital-first fashion space to focus on fewer brands made a lot of sense in the current climate. Frasers shares currently 1.5% to the good. And the specialist information, data and analytics company Essential has agreed to sell its digital commerce business to the US advertising and marketing giant Omnicom for £741 million. At the same time, the FTSE 250 company has agreed to sell WGSN, its product design business, to the private equity firm Apax Partners for up to £700 million, depending on how it performs in future. The deal will leave Essential, whose shares have risen by 35% on the news, as a focused events and exhibitions business.
Well, the oil price has fallen below $90 a barrel this morning after concerns over supplies in the Middle East eased. A barrel of Brent crude will currently set you back $89.49 a barrel. That's off a little over 1%. On the equity markets, well, after the sell-off on Wall Street on Friday evening, which saw the S&P 500 finish in correction territory, stocks in the Asia-Pacific region had a mixed session overnight. Hong Kong and Shanghai both finishing higher. The Nikkei was the biggest casualty in Tokyo, off by just under 1% on the session. Well, in Europe, stocks are higher this morning, right across the piece in continental Europe right now. Talking points today include Siemens Energy. It's ahead by some 6% in Frankfurt, and that's on hopes the German government will provide it with guarantees enabling it to complete big industrial projects. Well, here in London, the FTSE 100 also joining the party, currently up nearly 0.9% in a broad-based rally. In percentage terms, the biggest gainer on the FTSE this morning is Airtel Africa. You might recall we've had the CEO of that company on the programme in the recent past. Its shares currently ahead by 7% after its quarterly results were well received. Meanwhile, Rightmove is up by just over 2.5% after receiving a push from one of the brokers. To the downside, NatWest continues to be under pressure following Friday's disappointing results. Meanwhile, outside the FTSE, Essential, mentioned them a moment ago. Well, look, they were up 35%. They're up nearly 28%. That's not a bad result on the session so far. Elsewhere, Premier Foods is ahead by just over 2.25%. That's on news it's buying the breakfast brand Fuel 10K for up to £34 million. To the downside, WAG Payments continues to be under pressure following last week's profits warning. It's off another 3%. On the foreign exchange markets, well, things are pretty quiet, to be honest, ahead of a busy week of data. Sterling more or less unchanged against the greenback. It's off by 1/4% against the euro. Single currency up 1/5%, meanwhile, against the dollar. Well, with me now is Russ Mould, Investment Director at AJ Bell. Russ, great to see you this morning. HSBC, we've got to start there, really. It's the big corporate story of the day.
Yeah, and it's the last of the big five banks to report. Big jump in profits. But market, as it has with the other banks, has generally been fairly unimpressed. I think the issue here with HSBC is its costs are starting to rise. So that's something that's starting to concern people. Good news, no big increase in bad loans, but its costs are going up. I guess if there's a little bit of an encouraging sign, another meaty dividend, another big share buyback. And Noel Quinn, the chief executive, has said he thinks the Chinese real estate property market is starting to bottom. So let's hope he's right.
Well, that's for everyone's sake.
Yeah,
I mean,
exactly.
This does affect everyone. I mean, they also pointed out they're going to complete the sale of their French retail business in the first quarter of next year, and there'll be a special divvy on the back of that.
Yeah, it does mean the numbers are very messy. They announced this deal a year ago, wrote down the value of the bank, which is partly why you have this big year-on-year increase now, then wrote back the value of the bank and said, oh, we don't know whether this deal's going to happen or not. Now they're pressing ahead. Investors will be looking forward to this. It's a suboptimal business for the bank. And as you say, any proceeds will probably go back to shareholders, topping up already that hefty dividend and share buyback.
So what are your reflections on the UK banking results thus far? I mean, Lloyds looks to have been the star performer, really.
Yeah, I mean, I think no bad news on bad loans, I think, is the key thing. They were flat year on year. If you add up all of the big five banks, they were flat year on year. The challenge that they've got is their net interest margin. Again, that spread between the money which they can get in from depositors and then lend it out again. That seems to have peaked and is rolling over. And aggregate net interest income across the five, £18 billion in this quarter. Sounds lovely, but down from 20 billion at the end of last year. So that's quite a big drop. So I think that's what's probably got the market slightly on the back foot with these things.
So where are these deposits going then? I mean, obviously, Nationwide have got a big ad campaign at the moment on, but I guess National Savings is...
Well, if you saw the release that came out from National Savings today, £7.7 billion raised in September alone for their 6.2% bond. That met the year's funding target from National Savings and Insurance in a month. So competition is probably one of the big reasons why. And also, I think savers have got canny. They're looking for the best deal. They may be tying their money up for a little bit longer, but they are getting some better interest rates there, and that's what's probably putting a little bit of pressure on the net interest margin.
But why does the Treasury allow National Savings to blow a lot of the banks out of the water? I mean, it's anti-competitive, is one argument.
You could argue it is, but equally, I think the Treasury will say, well, you know, politically, it might not be a bad look to be giving the banks a bit of a hard time when they are still making £18 billion in 3 months in net interest income, and their net interest margin is way up from the lows of, say, 18 to 24 months ago.
But is National Savings the most efficient way for a cash-strapped government to be raising money?
I think, well, charging 6.2 when you're offering 6.2%, you can argue possibly not when your treasuries, your gilts, as it were, are offering less than that. So no, it's a pretty generous way of going about it, albeit a good one for the depositors.
Yes, and there are lots of them. We shouldn't.
And there are
forget
lots of them out there. We shouldn't forget that. So.
Now, among the other trading updates today, Pearson, another good set of numbers.
Yeah, I mean,
really.
after the difficult times under John Fallon, when there were multiple profit warnings, no, we shouldn't laugh, and a dividend cut, Andy Bird has done a good job in sort of steadying the ship. I guess now it's next leg under Omar Bosch when comes over from Microsoft next year. The testing and language did well. Educational publishing, still really tough, and the company talks a lot today about digitising, virtual reality, artificial intelligence. They're the big steps forward, and I guess hence the identity of the new Chief Executive Officer.
What do you think Andy Bird's going to do next? I mean, he doesn't really need to work. He made a lot of money at Disney. He'll presumably do well from Pearson because the share price has done
It's
very
done incredibly well under him after that very fallow period under Mr. Fallon. Yeah.
Do you think he'll come back in another?
I think there'll be a lot of people very eagerly following wherever he turns up, if he does turn up somewhere, yes, after the good job he's done here, very definitely.
Now, another one catching the eye today, Essential. Big. I mean, this is a root and branch restructuring of this.
I mean, it was first announced back in January and the share price shot up and then sort of dribbled away when nothing really happened. But two big asset sales and a stake sale today. They're looking to raise overall about 850 million, about £1 billion, and ship out some debt. And if all goes according to plan, 850 million of that will go directly back to shareholders through a special dividend. And that's nearly all of the market cap. So you're then left with a pure play events business, effectively valued at nothing, which I'm sure will catch the eyes of some people.
Well, that's bound to get snapped up, surely,
you would assume so, or certainly at the very least, the value hunters will be there having a good look at it, wondering who might be looking to pick it up, yes. And I noticed that the current Essential CEO is going with one of the assets that it's selling to Omnicom, so he's obviously voting with his feet, perhaps.
Yeah. Anything else catching your eye today, Russ?
I think we're probably all slightly waiting for the big three with the Bank of Japan and the Federal Reserve and the Bank of England Tuesday, Wednesday, Thursday. Though oddly, none of them really expected to do very much, I guess. We've heard that story that your colleagues picked up on Shein and Frasers. ASOS also rumoured to be looking at disposing of its Topshop business that it acquired from the fallen Arcadia empire from Sir Philip Green, just to, again, shore up the balance sheet after the recent rights issue. Yeah,
but how shocking that such a once valuable business is just being sort of peddled around.
You underinvest in a brandy and you can do an awful lot of damage to it very, very quickly. I mean, ASOS did pick it up very shrewdly, but again, they've got their challenges of themselves. We know the pressures on ethically, on sourcing, on margins and the customer's pocket. So, again, it needs to shore up its balance sheet again, perhaps a little bit as well.
All right, Russ, got to leave it there. Always
Pleasure.
good to see you. Thank you. Still to come here on Business Live, could a skills shortage scupper the UK's ambitions of being a leader in artificial intelligence? Don't go away.
I'm Greg Milam and I'm Sky's Chief North of England correspondent. We aim to be the best and most trusted place for news.
I'm Helen Ann Smith. I'm Sky's Asia correspondent, and I'm based here in Beijing.
Fly Emirates. Fly better. Fly Emirates. Fly better. Thank you.
Welcome back. Now, major fuel retailers have been called on to cut their prices by 5 pence a litre to reflect lower wholesale costs. The RAC has accused supermarkets of hiking their margins on petrol and diesel to around 14 pence per litre, which has doubled the long-term average of 7 pence a litre. An investigation by the Competition and Markets Authority concluded in July that supermarket fuel retailers had overcharged drivers by 6 pence per litre last year. Scotland, Wales and the north of England have suffered the biggest drop in wealth since the COVID-19 pandemic. Research by the Resolution Foundation has found a sharp decline in total household wealth in the UK from 840% of GDP in 2021 to around 630% in early 2023. It says the biggest factor is rising interest rates, which have hit pension valuations. Now, later this week, the UK government will host an artificial intelligence summit at Bletchley Park, the historic home of Britain's wartime code breakers and computer pioneers, bringing together political leaders, top executives from big tech and leading AI developers. Well, ahead of that, the tech consultancy Nash Squared has been looking at how prepared businesses are for the AI revolution. It's found that only 12% of tech leaders say they're prepared for the demands of generative AI. 90% believe that stronger regulation of AI is essential, but 66% say it won't solve all the risks. Well, joining me now to talk about this is Bev White, Chief Executive of Nash Squared. Bev, nice to see you this morning.
You too.
You surprised by these findings?
No, not really. I think about when cloud computing was first coming in, we had very similar situations. And you think about, just how much data privacy you need to concern yourself with when you're putting a lot of your systems out into AI world.
But I mean, 90% of tech leaders want AI to be regulated more aggressively. I can understand that if it's politicians, but these are people that work within the industry.
Absolutely, but think about, just how much you're exposing of your organisation, the knowledge that you have externally, and I think you need to protect your own people inside your business.
The one thing in your survey that really jumped out at me was that, again, this is UK tech leaders, only 1 in 10 of them have implemented for large-scale, well, they plan for large-scale implementation of AI. I find that incredible.
Again, let me take you back to cloud computing. It was a very similar story there. So this is a large investment on a large scale. So the best way that organisations could prepare themselves, in fact, 49% of them are saying exactly this: small-scale implementations, small use cases where you can protect the boundaries and really understand the impact.
But I thought a lot of people working in tech were supposed to be able to sort of see round corners. They're better at future casting than a lot of CEOs.
Well, maybe that's true, but I think all of us need to think about where we're making our investments and what the use cases really are. Bear in mind, ChatGPT has only been out, 1 year? So it's in its infancy. It's growing rapidly, of course, and it's fantastic. This week there's a meeting, of course, you referenced.
Now, you found that only 1 in 5 companies has a AI policy in place.
Yes.
Again, I find this just extraordinary.
Well, there are so many different elements that you need to consider. So you have to think about data privacy, you have to think about training, you have to think about, what you can hold your employee accountable for, what you as a business are exposing yourselves to. So all of those elements could really do with some guidance from regulation, and a regulator with a strong hand is really necessary here.
But I imagine, the Prime Minister's called this summit because he wants the UK to be a leader in AI. He'll throw up his hands in horror if he reads your survey here, because essentially it shows that our industry really doesn't seem to be doing its best to sort of grab the opportunities from AI.
I think the opposite. 49% of organisations are investing right this moment in smaller projects to learn how they can best implement it. I think you'll be thrilled, actually.
OK, well, I stand corrected. What do you think is going to come out of this summit?
I'm hoping that we're going to see some regulation coming from it in the coming months. I think what they're looking at is frontier AI models, which, of course, are really pushing the boundaries of working with society as a whole. And, of course, the boundaries go around the world. I mean, they're boundary-less, aren't they? When you say frontier developments, you're talking about things like DeepMind. I am. Yeah, absolutely. But even kind of the way that we book, perhaps, our travel. So that might be considered a frontier AI system. And interacting with a chatbot and exposing your personal finances online, that's a risk, right? So now take that to another level in a very large-scale organisation. Was it a mistake by Rishi Sunak to invite the Chinese? I think there are no boundaries in this world, and I think it's a really great thing that everybody's included. Now, this survey that we've been talking about, this was a global survey. We've only really been talking about the UK dimensions. What are the sort of thoughts on this further afield? Pretty much similar, actually. And again, I'm not surprised because IT is really permeates every part of society, all countries. Our survey covers 86 countries. And what we're seeing is the same trends. Large scale, very slow pace right now, but really rapid pace for smaller. Do you think that over time companies are going to adopt a more sort of freewheeling approach? They're going to be less het up about regulation? No, I don't think so. I think we're actually going to see a more cautious approach to this, and I think it's a necessary thing. All right. Bev, got to leave it there. First time we've had you in the studio. We've had you down the line in the past, but never physically here, so good to see you. Thank you. You too. Thank you, Ian. That's it from me. I'm going to be back at 4:30 this afternoon with our afternoon edition. I hope very much to see you then. In the meantime, do stay tuned. We'll have all the latest from Israel and the Gaza Strip and, of course, the latest from the COVID inquiry. See you later on. Cheerio.